Hi everyone, welcome to Investing Club. In this video, I'm going to show you 3 different ways you can use options as a way to hedge your stock portfolio to protect yourself if we see another stock market crash. Options are something that are important to utilize. They'll help you take advantage of different market environments where we're not seeing stocks go up. If we see a crash in the stock market, it doesn't really matter what stocks you own, they're most likely all going to go down at least somewhat. And that's why it's important to know how to use options that will actually increase in value when the stock market goes down. So in this video, I'm going to be showing you 3 ways to do this, a couple of which are really not that expensive. Before we get started with this video, know that I am not a financial advisor and this is not financial advice. And in this video, I'm going to be talking about using options to hedge your portfolio. And inherently, options are very risky, and options have the possibility of losing 100% of their value. So just keep that in mind. Options are inherently very risky. You could lose all of your investment, and if you don't know anything about options, it's probably best to spend time learning about them before just jumping in to these strategies. And I'm not recommending you do any of these. I'm just simply displaying them to you for educational purposes so you know the type of options out there and the type of methods you could use to protect your portfolio in the event of a stock market crash. So I got the idea for this video from Adam Koo. He is an options expert, so definitely check out his channel. So now let's get into the video. The best way to think about using options to hedge your portfolio is like buying insurance for your stocks. So you can think about it in the same way as like fire insurance for a house. If you own a house, you probably pay for fire insurance. And so every year you pay a premium to the fire insurance company so you're protected if your house burns down in a fire. You will get paid out. Now, when you pay the premium to the insurance company, do you want your house to burn down? No, of course you don't, right? But in the event that it did happen, you would be protected because you paid this upfront cost. So with something like insurance, you pay the upfront cost, the premium, and then you want nothing to happen from it. You want to pay it and then just have everything stay like it is. That would be the ideal situation. And that is the same with options. With options, and specifically put options are what I'll be talking about. You pay a premium upfront, and then if stocks continue to do well and keep going up, you lose the premium, but that's okay because your stock portfolio has been going up. On the other hand, if we do see a stock market crash, that would be like your house burning down, where your stock portfolio is going to go down, but because you pay this upfront price for these put options, you're protecting your portfolio, and those will increase in value equivalent to the amount that your portfolio decreased. So that will leave you with the same overall account value. So let's get into 3 ways on how I do this. And the first way is simply to buy a put option on the S&P 500. And for the sake of this video, let's say you want to protect your portfolio from a stock market crash for the rest of the summer. So with options, you have to pick a time frame. And so you can pick any amount of time that you want. For the sake of this video, let's say through the end of the summer, through the end of August, we want our portfolio to be protected in the event of a stock market crash. So the first thing we could do is buy a single put option. And when I buy a single put option, I want it to expire 30 days after I want to be protected by, because the last 30 days is when the option really loses value due to time decay. So the closer these options get to expiration, the less they'll be worth. And by having a 30-day buffer from the expiration time, these options will still be worth more at the time you want to be protected by. So if you want to be protected through the end of August, we could pick an option like the end of September. So we could do this option right here that expires September 30th, the end of September. And we also want to pick a strike price. Now, this isn't a video where I'm going to get super into detail on options, but in general, for a strike price, I usually like to choose a strike price right at the money or one strike in the money. So for a put option, right now the SPY is at $311. So for a put option, I would buy either the $311 or $312 stock price. So let's go with the $312 strike price just for this example, and we're going to analyze what this option will do in the event that the stock market falls. So we'll buy a single put option, okay, and then we're going to analyze this trade. And so here is what the profit and loss graphs looks like. And the only thing you need to know is that the green line is what the option is worth at expiration. So on September 30th, if you held this option until then, what the option would be worth at each price that the stock market is at, and the purple line is the price of the option today. And so we can simulate this using this calendar down here. If we want to hold this option until the end of August, we can see what the option will do at the end of August. So we can go to August 31st. So if you held this option until the end of August, here's what you need to know. The break-even price is right here where this red dash is, and it is at right around $300. So right now the SPY is trading at $311, and if it's below $300 by August 31st, then this option will be profitable. You will make money with this option if you sell it then and the S&P is below 300. Now, I like to take a look at what happens in the worst case scenario. Let's say worst case, by the end of August, the stock market will be back down at its lows that we saw in March. So if we take a look at where that was, the S&P was around 200, we'll call it around $220 at its low in March. So if we get back to that point, if that's what you're concerned about, that we would see a drop down to that level by the end of August, we can take a look at this and you can see this option really increases in value. So if we get down to 220, we'll see that this option is worth around $7,597. We'll call it $7,600. And so the price of this option, I never said that, the price of this option is right down here. It's $16.17. And with options, you multiply that by 100. So the price of this option would be $1,617. So you can think of that as the insurance premium for your portfolio, paying $1,617. And if we saw the S&P 500 drop to the level of 220 where it was in March, and you receive around $7,600, and you can call that the insurance payout from the stock market dropping. So that is probably the simplest strategy to use when you want to hedge your portfolio, just buying a put option right around the money and planning on selling it before expiration. This is what you could do. You could turn $1,617 into $7,600 if we see the worst case happen. Now, there's a few things I don't like about this. First, this option is expensive. It's $1,600, and something to note is that the volatility in the stock market is high right now. The VIX is still elevated, and when we have a lot of volatility, option prices are going to be more expensive. So right now, we still are experiencing high volatility. There's still a lot of fear in the markets, and because of that, you're going to have to pay more for options. Another thing I don't like is the time decay. So like I said, we want to sell this 30 days before expiration because that's when time decay really eats away at the value of this option. But it's not only in the last 30 days. Every day you own this option, it's going to lose some of its value due to time decay. The less time that's left in the option, the less it'll be worth. So it's really those two things that make me not like this strategy that much. Now, thankfully, there's another way very similar to this that will allow you to get rid of the time decay risk and the volatility risk, and that's what we're going to talk about right now. So the second way you can use options to hedge your portfolio is called a vertical spread. And so what you're going to do is, it's very similar to the first one where we just bought a single put option. For this strategy, we're also going to buy a put option at the money, but then we're going to sell a put option at the strike price where we think is our worst case scenario. So using the example that we just said, we would buy a put at a strike price of around $312, then we would sell another strike at $220. And there's a couple benefits to using this opposed to just buying one put option. The first one is that you're not going to have as much time decay because you're also selling an option as well as buying one. You are going to be offsetting that time decay from the gain you'll get from the option you're selling. And the same thing with the volatility. Even though the volatility is high, that also means while you'll pay more for when you're buying the option, when you're selling the option, you'll receive more in premium. And lastly, this is a cheaper strategy because you can use the money you get from selling the premium to finance part of the put option you are buying. And so because of that, you're usually paying a lower overall cost. And another thing I like about this option is that you don't have to buy it 30 days before expiration. You can have it expire right around when you want to sell it, again, because you're not experiencing any time decay. So using that, we can have this option expire at the end of August. The closest one is August 21st. And again, we're going to go to the put options and we're going to buy the $312 put option, and then we're going to buy a vertical spread. So like I said, we're going to buy the put option at $312, and then we're also going to sell one. And like I said, you usually sell the option on where your worst case scenario is for where the stock market will go to. And like we said, if it goes to the level at the end of March, it would be around $220. So there we go. And now we can also analyze this trade. So there's a few things to note right off the bat. First, the total price you're paying is $1,119. So that is cheaper than the $1,600 we were paying for the single put option. And that's because when we sell an option, we receive a premium that we can use towards buying the other option. So that's what I like about this strategy. Now again, we can take a look at what this would look like on expiration, which is around August 21st. So if we go to August 21st and we can see this break even is at around $300 again. So the break-even price is pretty much the same. As long as the SPY is lower than 300, you're going to be making money with this option. And in terms of the worst case, if the SPY did get back down to 220, we can see that this option would be worth around $7,800. So I like this method better than the first one we just looked at, which is just buying a single put option, because you're paying less and you have the opportunity to make more. Your risk to reward is higher. You're only paying $1,100 and you have the potential to make $7,800 if we see a stock market crash. So this is another thing you can do to hedge your portfolio where you're paying $1,100 in premium and you'll receive a nice payout if you see a stock market crash. Now, the problem with this is that it's still sort of expensive. It's still $1,100, and that's something just a lot of people don't have to be able to use towards a hedge, where the best case scenario is the stock market goes up and it becomes worthless. So this last option strategy I'm going to use, which is one that is a lot cheaper than these previous two methods, and it's going to allow you to have a greater risk to reward than what we just saw. So for this method, we're going to buy options on the VIX. And the VIX, if you don't know, is the volatility index. So this measures the volatility in the stock market. And the important thing about volatility is when the stock market falls, volatility usually goes up. And buying options on this volatility index instead of the S&P 500 itself will allow us to see a greater risk to reward. So taking a look at where the VIX went, we saw the fastest stock market drop in history back in March, and the VIX went all the way up to 85. And right now it's come back down, but it's still high, and it's still almost at 30. And just for some context, before this, back in January and February, the VIX was at around $10, $11. So that is how much this VIX can move when we see huge swings in volatility. So for this strategy, we're going to want to choose a longer expiration date, because as we'll get to, you're going to want to sell this before it gets close to expiring. So we're going to choose the November expiration date, and what we're going to do is called a back ratio. So what you do is you sell one call option slightly out of the money, and then you buy two call options farther out of the money. So what we could do is we could buy the $40 strike price for the VIX, and we could buy, is right here, back ratio. So like I said, for the call option you're selling, it's going to be at the $40 strike price, and for the two calls you are buying, it is going to be at the $50 strike price. So again, we're at the end of August, and the break-even price is around $38 for the VIX. So again, if we go to where the VIX is now, it's at around 28, and 38 where the break even is at around this point. So it's not far. If we do see another stock market drop, it's likely the VIX is likely to get up to this level. Now, if we see the VIX get to 50, which is if we see somewhat of a fast drop, the VIX could realistically get to 50. So if we saw that, this option would be worth $366. And the best thing about this option is the price. It's only $110 to purchase. So it is lower price than these other ones. And if we did see the VIX get to around 50, the $110 would turn into $366. Now, if we saw the VIX really spike up to the levels that we saw at the end of March, where we saw a very fast drop, the VIX was at 85. So if we did see that again, this option would be worth $2,700, again, when you're only paying $110 for it. So that's the kind of risk to reward you have with this, using the VIX instead of the S&P 500. That's why I think this is a better strategy than the previous two. Now, there's a couple problems with this. First, the VIX isn't exactly correlated to the S&P 500. So yes, if the stock market does fall, the VIX usually does go up, but it depends what kind of drop we see in the stock market. If we see a sudden extreme crash like we did in March, the VIX is going to shoot up because everyone's scared it's going down so fast. But if we just see a steady decline where the stock market sort of goes sideways and is slowly drifting downwards, yes, the VIX probably will increase, but not to the same level as if we saw a fast drop. So that's the first thing to know with this, is that the VIX moves up the most when there's a extreme, quick, unexpected drop like we saw in March. The other thing to know is that even though you only paid $110 for this option, there is the chance that you lose more money than that if you hold this option until expiration. So again, if you held this option until the expiration in November and the VIX was at 50, worst case, you could lose around $1,100, even though you only paid $110 for this option. Now, an easy way to prevent this from happening is watching this option and selling it before the expiration. So right now, the purple line is August 26th. And at that time, you would still be up $365. So just know that if you were planning on selling this at the end of August, you wouldn't risk losing more than you paid for. But if you hold it on longer, we can take a look at, if we go to September, and we keep going, we keep simulating the days. Once we get to around October is when you really want to watch out, because that's where the purple line starts to go into this negative territory, where that's where you could see a farther drop. And again, as we keep increasing the days, your max loss becomes bigger and bigger until it gets to the green line, which would be your max loss if you held to expiration. So that's the thing to note with this option. You have to watch it and you have to sell it before the price starts to get down to a point where you could lose more money than you paid for the option. But otherwise, if you kept your eye on this and you knew you were going to sell it before, say, by the end of August, then your max loss is very small. And so this is probably my favorite option out of the three, because of the low cost is $110. And again, if we saw a drop in the stock market similar to what we saw in March, the VIX could shoot up, and like we saw, you could turn the $110 into $2,700. So that's it for this video. Those are the 3 methods you can use to hedge your portfolio in the event of another stock market crash. Some of these are complex option strategies, so if you have no experience with options, it's probably not best to jump right into these. You should spend time learning about options before you start playing around with complex strategies. But if you know how to use them right, they can be a very helpful tool in limiting your losses, even if stocks go down. So let me know what you think of this video. If you learned something, hit the like button, subscribe to the channel, and hit the little bell icon to see whenever I upload a new video. And that's it for this video, so I'll see you on the next one.